Welcome back to the deep dive. This is the place where we take the densest, most high stakes financial information, the stuff that usually makes your eyes glaze over, and we try to transform it into clear, usable, and frankly, actionable knowledge.
And today, we are diving deep into a topic that is just foundational to retirement wealth management in the U.S., but one that's often misunderstood, sometimes intentionally, required minimum distributions, or RMDs.
Okay, let's unpack this with a scenario that I think touches nearly every successful saver. So you, the diligent person, have spent decades dutifully funding your traditional IRA or 401k.
Right. You took advantage of that glorious tax deferral, watched your money grow.
Exactly. You thought, I'm set. You've successfully managed to keep the IRS at bay for maybe 30, 40 years. Then a few years into retirement, the government steps in and says, we're happy you saved, but that tax deferral is ending. Time's up. You must withdraw.
And that is the core legal and financial concept of RMDs. It is the federal government enforcing the terms of the deal you made when you opened that account all those years ago.
Okay, so the official term is actually different, isn't it?
It is. The precise language in the Internal Revenue Code is minimum required distribution. But both tax practitioners and frankly, the IRS itself widely use the phrase required minimum distribution, or RMD, so we'll just stick to that.
Our mission today is laser-focused. We're tackling this U.S. tax law requiring annual withdrawals from those tax-deferred accounts. We want to transform this complexity, which is rooted, deeply in Internal Revenue Code, Section 401A9, and then got totally scrambled by the Secure Act into clear takeaways.
And most importantly, we want to focus on preventing you from falling victim to the truly, truly massive 50% penalty for failure to comply.
We're drawing from the detailed legislative and regulatory context, right?
Yes. The Secure Act in particular introduced major curveballs, both for the age at which distributions must start and perhaps even more critically for how beneficiaries have to take distributions after the account owner dies.
So let's start with the big question. Why do RMDs even exist? If the government encourages saving for retirement, why do they eventually turn around and force you to take the money out? It feels a little like a bait and switch.
It really comes down to the explicit intent of these tax advantage vehicles. They were never meant to be permanent, infinitely deferrable wealth preservation tools for, multi-generational inheritances.
So they weren't intended to be a tax-deferred estate planning tool.
Exactly. The RMD rules are explicitly designed to ensure that the retirement funds are distributed and, crucially, taxed during the holder's lifetime. They force you to eventually convert those deferred funds into taxable income, spreading those distributions out over a statistically determined life expectancy.
And the government needs that revenue.
Well, of course. This is key for government fiscal planning. They're relying on that future tax revenue. If everyone kept the money deferred indefinitely, the immediate fiscal incentive for offering the deferral in the first place just disappears.
In other words, the IRS wants its cut, and they want it on a schedule based on actuarial tables. And that schedule, unfortunately, has been a moving target, which leads us directly into the first high-stakes area, knowing exactly when that timer starts ticking for you.
The complexity of RMD compliance largely hinges on one question. When must you start taking that first withdrawal? Knowing this exact age and its corresponding deadline is, I think, the single most critical piece of knowledge for any account holder.
Get this wrong, and you expose yourself to that 50% penalty.
Immediately. And this is where the law has been changing the most, often retroactively. It's no longer a simple universal age like it was for decades. You have to look at your date of birth, specifically the year you hit a certain age, to determine your starting line.
And this is all thanks to the Secure Act, which now gives us 3 distinct key age tiers. It's like the government moved the goalposts mid-game, and everyone has a different set of rules depending on when they were born.
Let's clearly define these 3 tiers. The oldest tier, the sort of pre-secure world, is age 70 and a half.
I remember that one. That was the rule forever.
It was. And it still applies to individuals who attained age 70 and a half on or before December 31st, 2019. So if you were born in the first half of 1949 or earlier, this is your age.
Okay, tier 1. Then came the first big shift.
Right, the first major legislative shift, pushing the starting age to 72. This applies to individuals who attained age 70 and a half after December 31st, 2019, but who attained age 72 on or before December 31st, 2022.
Wow, that's a very tight window.
It's a very narrow group, essentially covering those born from the latter half of 1949 through 1950.
And now we have the third tier.
And we're currently operating under the latest and highest threshold, driven by subsequent tweaks to the Secure Act, age 73. This applies to individuals who attain age 72 after December 31st, 2022. So if you were born in 1951 or later, you get the benefit of this extra year of tax deferral, waiting until age 73 to begin RMDs.
That is just so confusing because it forces you, the individual, to become a chronological detective. You can't just look up RMD age anymore.
You really can't. You have to look up your birth year and determine which tier you fall into. For example, if you turn 70 in 2020, you fall into the age 72 category. But if you turn 70 in 2023, you fall into the age 73 category.
So the difference of a single calendar year can mean 1 or 2 extra years of tax deferral.
It can. Or, if you miscalculate, an immediate 50% penalty on a misdistribution. That's why precise age tracking is just paramount.
Now let's talk about the absolute deadline, because the age is only the starting pistol. The deadline itself has this weird flexibility that can actually lead to tax headaches.
It can. The deadline rule is the second layer of confusion here. Regardless of whether your required starting age is 70 and a half, 72, or 73, the deadline to take your first RMD is April 1 of the calendar year following the year in which you reach that specified age.
Okay, that April 1st deadline is critical because it offers a grace period. So say I reach age 73 in 2025. My first RMD is technically for the 2025 tax year, but I don't have to take it until April 1st, 2026. Why would anyone want to do that?
Well, the flexibility is there for, say, cash flow management or maybe some last-minute planning, but it carries a pretty severe tax consequence. Income bunching.
Income bunching. What's that?
If you wait until April 1, 2026 to take your first RMD, the one for 2025, you must also take your second RMD, the one for the 2026 tax year, by December 31st, 2026.
Oh, wow. So you could have 2 RMDs, 2 full years' worth of taxable income lumped into a single calendar year. Why is that such a problem for a high net worth individual?
Well, the surge in income can spike your adjusted gross income, your AGI. This doesn't just push you into a higher marginal tax bracket.
It has ripple effects.
Huge ripple effects. It can trigger all these secondary tax hits.
Mm.
Crucially, it can increase the portion of your Social Security benefits that are taxed, and it can significantly raise your Medicare Part B and Part D premiums through something called IRMAA.
IRMAA, the income-related monthly adjustment amount. We've talked about that before. It's a killer.
It is. So delaying that first RMD might seem like a small convenience, but the cascading tax consequences often make it a very expensive planning mistake.
So for most people, the cleaner, simpler way is just to take the RMD in the year you actually hit the age.
In almost all cases, yes. It's the best way to manage your tax rackets.
Okay, so we know the start date. But how do we actually calculate the amount that has to be withdrawn? This is where the IRS life expectancy tables come in, right? And I think this is where a lot of people just panic and rely on their custodian.
And you shouldn't have to. The calculation is surprisingly formulaic once you know the 2 key variables. The formula is simply the account balance divided by the life expectancy factor.
Okay, let's break down those 2 variables. First, the account balance.
The account balance is standardized as the fair market value of your retirement account as of December 31st of the immediately preceding calendar year. So for your 2025 RMD, you use the balance from December 31st, 2024.
Got it. And the second variable is the life expectancy factor. Where does that number come from?
That comes from the IRS's official Uniform Lifetime Table. The IRS updates these tables periodically to reflect current life expectancy. The factor is based on your age in the current distribution year.
Okay, can you give us an example?
Sure. The 2022 table, which is the current one, shows that a 73-year-old has a distribution period, or factor, of 26.5 years.
Let's apply this. So say a 73-year-old has a balance of $1 million on December 31st of last year. How much do they have to take out?
You'd take the $1 million balance and divide it by that 73-year-old factor, which is 26.5. That gives you a required minimum distribution of $37,735.85 leverage for that year.
And the next year, you just do it again?
You do it again. The following year, you're 74. The factor is a little bit smaller, which means the RMD is a bit bigger, and you divide it into the new December 31st balance.
I see. And this uniform lifetime table applies to most people, right? I heard it assumes a joint life expectancy with someone 10 years younger.
That's the key benefit of it. It automatically maximizes the distribution period for the account owner. The only time you use a different table, the joint life expectancy table, is if your spouse is your sole primary beneficiary and they are more than 10 years younger than you.
And in that case, you get an even better deal.
An even longer factor, yes. It allows the distribution to be stretched even further.
So that makes the calculation manageable as long as you know your age and last year's balance.
It's just arithmetic at that point.
Before we get to the terrifying 50% penalty, let's cover who gets a pass on these lifetime distributions. The biggest one that comes to mind is for Roth IRAs.
That's a huge tax planning benefit. IRA owners do not have to take lifetime distributions from Roth IRAs. The funds can continue to compound tax-free throughout their lifetime.
So RMDs are never required for a Roth.
Not during the owner's lifetime. The only time RMDs are required from a Roth IRA is after the owner dies, for the beneficiaries, and that follows a different set of rules we'll get into later.
So if I have a mix of traditional and Roth IRAs, I'm only forced to withdraw from the accounts where the tax was deferred, the traditional ones, while I'm alive. The Roth is protected.
Correct. The lifetime RMD rules only apply to tax-deferred accounts.
What about flexibility? Say my calculated RMD for the year is $40,000. Can I decide to take out $60,000 because I need cash for something?
Absolutely. The rule dictates the minimum required amount. An individual can always withdraw more than the calculated minimum in any year.
But I can't bank that extra, can I? I can't take extra this year and have it count for next year.
No, you can't. Each year is calculated independently. And this leads us to the high-stakes distinction regarding rollovers. The RMD itself is mandatory and taxable. You cannot roll it over.
Right. Never.
RMDs are never eligible for rollover. They are mandatory taxable withdrawals. But there's a crucial distinction. Any amount withdrawn above the minimum required distribution is eligible for rollover.
Okay, so in my example, I take out $60,000 and only $40,000 was the RMD. That extra $20,000 is a voluntary distribution.
Precisely. And that excess $20,000 can be rolled back into another IRA or qualified plan, but you have to do it within 60 days of the distribution.
That's an important escape hatch.
It's very important for people who might be liquidating assets in their IRA and accidentally withdraw more than they meant to. They can correct that mistake, but only the excess portion. The RMD must stay out.
Now we get to the consequence that frames this entire discussion. If you get the age wrong, the calculation wrong, or you just forget, the financial consequence is devastating. Let's make this massive excise tax crystal clear.
The risk is it's existential for your retirement savings. If an individual withdraws less than the RMD amount for the year, they face a severe federal penalty. This is an excise tax equal to 50% of the amount they failed to withdraw.
50%. That's not a typo. That's a penalty rate that just dwarfs virtually every other penalty the IRS levies on retirement accounts. So if you were required to take out $100,000 and you took out nothing, the penalty alone is $50,000.
And that number is why RMD compliance is mandatory reading. But it gets worse, because we have to account for what we call the layered tax hit. This 50% penalty is in addition to the original ordinary income tax you still owe.
Wait, I owe the penalty and the income tax? I thought the point of the penalty was to punish me for avoiding the tax.
It's a common misunderstanding. The penalty is for the administrative failure to comply with the distribution schedule. The income tax is still owed on the amount that should have been distributed because it came out of a tax-deferred account.
So walk me through the math. Let's use that $100,000 example.
Okay, you miss a $100,000 RMD. Let's say you're in a 30% combined federal and state income tax bracket. You owe the $50,000 penalty plus $30,000 in income tax on the $100,000 that should have come out. That's an $80,000 catastrophe resulting from a $100,000 oversight.
That is truly devastating. It turns a simple administrative mistake into a financial catastrophe. How often does this actually happen?
Unfortunately, it happens more than you'd think, especially in the years right around the starting age, or when people transfer accounts between custodians and the tracking gets lost.
Is there any way out?
There is. The good news is that the IRS has Form 5329, where you report the missed RMD, and crucially, you can petition for a waiver. They require a clear demonstration that the shortfall was due to reasonable error and that you've taken reasonable steps to fix it.
And what are reasonable steps?
Usually it means immediately withdrawing the full amount that was missed, plus any earnings that money generated while it stayed in the account. You file the form, you include a letter of explanation, and you hope for the best.
So you're at the mercy of the IRS.
It's a high-stakes gamble. The safest route is always timely compliance by December 31st.
Okay, we know when to start, how to calculate, and the catastrophic risk. Now let's pivot to the logistics of where the money is sitting, because the rules change depending on whether your funds are in a personal IRA or an employer-sponsored plan like a 401k.
Right. This section is all about operational differences that introduce either planning opportunities or administrative nightmares. While the basic age requirements are the same, how you interact with the plan is entirely different.
Let's start with employer plans like 401k. Is there anything special about them?
Employer-sponsored plans, like 401k, generally require RMDs based on the same life expectancy factors. But there is one huge timing difference known as the still working rule.
This is a massive benefit for people who are happy to stay in the workforce past 73. It's an extra tax deferral loophole.
It is, provided you meet the criteria. Participants in an employer plan can usually wait until April 1st of the calendar year after they retire to begin RMDs from that specific employer plan, if that date is later than their standard RMD starting age.
Let's nail this down. So if I turn 73 in 2025, but I don't actually retire from my current employer until 2029, I can potentially delay RMDs on that specific 401k until April 1, 2030.
That's right. 5 extra years of tax-deferred compounding. It allows you to delay taxation on the income source you're still contributing to.
But there are some catches, right?
2 big ones. First, this delay only applies to the plan sponsored by the company you're currently working for. Any IRAs you have, or any 401ks from previous jobs, must still start RMDs at age 73.
That's a key distinction. So your old 401ks must start distributions even if you're still working full-time at a new job.
Correct. And that brings us to the second and most important limitation, especially for small business owners, the 5% owner caveat.
Okay, who gets caught by this rule?
If you own 5% or more of the employer sponsoring the plan, this is very common for partners in small firms, medical practices, or closely held businesses. This still working delay exception does not apply.
So if I own 6% of the company sponsoring my 401k, the IRS says I have enough control over my own employment that I have to start taking RMDs at 73, even if I'm running the company full-time.
You lose the deferral benefit immediately. This is a common trap for entrepreneurs and small business founders who expect it to work indefinitely. They are automatically treated like IRA holders for RMD timing.
Okay, that's a big one to watch out for. Now let's talk about the aggregation game. This is a point of tremendous practical importance for people with diversified retirement holdings.
It really is. This is the difference between the single pot concept for IRAs, which offers great flexibility, and the separate pots concept for most employer plans, which demands administrative rigidity.
Let's start with the easy one, the convenience of the IRA aggregation rule.
This rule is a massive convenience. If a person has multiple IRAs, say a traditional IRA, a rollover IRA, and a SEP IRA, they have to calculate the RMD for each account based on its individual balance.
Okay, so 3 separate calculations.
3 separate calculations. But then they can add up those separate RMD requirements to get the total RMD required for the year. And here's the benefit.
I can then take that total aggregate amount from whichever single IRA I choose. I don't have to touch all 3 accounts.
Exactly. This offers crucial liquidity and investment flexibility. Maybe one IRA is invested in something volatile you want to sell, or another holds illiquid assets you don't want to touch. You calculate the required total, and you satisfy it using the most advantageous account.
Now contrast that with the employer plan separation rule. If I have 2 separate 401ks from different old jobs, I can't aggregate those RMDs, can I?
You absolutely cannot. Employer-sponsored plans must remain entirely distinct. The RMD calculation for Plan A is done separately, and that distribution must be taken only from Plan A. The RMD for Plan B must be taken only from Plan B.
So they're separate pots?
Separate pots. And satisfying one with funds from the other is a mistake that triggers the 50% penalty on the unsatisfied plan.
That means if I left a small 401k with an old employer that is now invested in something obscure, I have to go through the headache of initiating a withdrawal from that small account every single year.
It can be a massive administrative burden, especially if you have multiple small residual plans. This is why many financial advisors recommend consolidating old 401ks into a single rollover IRA, precisely to gain the benefit of the IRA aggregation rule.
But there is one special exception tucked into the code, isn't there? The 403B exception.
Yes, the 403B tax-sheltered annuity, often used by nonprofits, public schools, and hospitals, gets special treatment. Individuals with multiple 403B accounts can total their RMDs and take the full amount from any one or more of those specific annuities.
So they operate like IRAs in that one context.
They do. It's a nice bit of flexibility for those in the nonprofit and education sectors.
Before we transition out of lifetime distributions, we have to talk about the most powerful tax planning tool available once RMDs start, the Qualified Charitable Distribution, or QCD.
This is where you can turn a mandatory withdrawal into a tax-efficient donation, which minimizes the impact of the RMD.
And the tax advantage is profound, isn't it?
It is. Income tax is generally not due on any part of the RMD from an IRA, which is paid directly to a qualified charity. There's an annual limit, and it must come specifically from an IRA, not an employer plan.
Let's drill down into the mechanism and why it's so much better than just taking the RMD and then writing a check to the charity.
Okay, so When you take the RMD and then donate, the RMD amount first shows up as taxable income on your tax return.
Hmm.
Then you can only deduct the charitable contribution if you itemize deductions.
Which, after the Tax Cuts and Jobs Act, a lot of people no longer do. They just take the standard deduction.
Exactly. So if you're taking the standard deduction, you pay tax on the RMD and you get zero tax benefit for the donation.
But with a QCD.
With a QCD, the money is transferred directly from the IRA custodian to the charity. It never touches your income line. It satisfies the RMD requirement, but it is excluded from your adjusted gross income, AGI.
That AGI exclusion is the magic trick here. It's not just about saving on income tax, is it?
Not at all. It's the secondary effects. By reducing your AGI, you gain several tactical advantages. It can reduce how much of your Social Security is taxed. It can help you avoid or reduce those costly Medicare IRMAA surcharges. It can even keep you below thresholds that trigger higher capital gains taxes.
So if I have a $45,000 RMD and I donate $15,000 of it via a QCD, that $15,000 never shows up as income, and it also satisfies $15,000 of my required distribution obligation.
It's a double benefit.
Yeah.
Maximizes the value of the distribution while helping manage the entire tax picture. It's one of the most powerful tools in post-R&D financial planning.
We've successfully navigated your lifetime withdrawals, but now we enter the most chaotic and complex chapter, the rules governing your assets after you pass away. This is often where even the best-laid plans completely fall apart.
We're moving squarely into estate planning territory. And the complexity is driven entirely by three factors: the relationship of the beneficiary, whether you die before or after your RMD started, and of course the legislative changes from the Secure Act.
Let's start with the best-case scenario, the spousal advantage.
Right. Spouses have the greatest flexibility. They have several options, but usually the most beneficial choice is to just treat the inherited IRA as their own.
Meaning the surviving spouse can roll the funds into their own IRA or just retitle the account and then delay taking any distributions until they reach their own RMD starting age.
Precisely. It allows for maximum continued tax deferral. Non-spouse beneficiaries, children, siblings, friends, they face a much tighter and less flexible set of rules.
And this is where the distinction between IRAs and 401ks historically used to trip people up.
You really did. Before 2007, non-spouse beneficiaries had very limited choices when inheriting a 401k. But the Pension Protection Act of 2006, which went into effect in 2007, fixed this by allowing qualified plans to offer a non-spouse rollover.
And what does that rollover achieve?
It permits a direct transfer of the funds from the employer plan into a brand new inherited IRA. This is critical because the inherited IRA framework is standardized and offers the non-spouse beneficiary the most favorable distribution options.
And there's a very specific titling requirement for that inherited IRA, isn't there?
Yes, and it's crucial. The new account must be titled specifically in the name of the decedent for the benefit of the named beneficiary. So, for example, John Smith IRA, deceased FBO Jane Doe beneficiary.
And that structure keeps the inherited money separate from Jane's personal money.
Exactly. It ensures the inherited funds are subject only to the required inherited IRA distribution rules. IRA custodians are usually pretty good about this retitling process, which is simpler than the formal rollover needed from a 401k.
Okay, so this is the critical line in the sand for beneficiaries. The entire payout schedule for the non-spouse inheritor hinges on one single date.
It does. The core determinant is this: did the decedent die before or after their RMDs officially started? Specifically, did the death occur before or after April 1st of the calendar year following the year they would have reached their required beginning age?
Let's focus on the first scenario. The decedent died before that critical April 1st deadline, meaning before RMDs had officially started. In this pre-RMD death scenario, what are the choices for a non-spouse beneficiary?
In that scenario, the beneficiary typically had two primary choices, though the Secure Act has narrowed this dramatically for new inheritances since 2020. Before 2020, the main choice was the stretch payout.
The stretch was the gold standard, particularly if the beneficiary was young.
It absolutely was. The beneficiary would begin distributions by the end of the year following the decedent's death, and they could spread those payouts over their own life expectancy using the single life expectancy table. A 30-year-old child could stretch distributions over roughly 53 more years.
But the Secure Act eliminated the stretch for most non-spouse beneficiaries for deaths after December 31st, 2019.
It did. It replaced it with the 10-year rule. The old 5-year rule and the stretch only apply now under specific legacy rules, or if the beneficiary is an eligible designated beneficiary, like a spouse, a minor child of the decedent, or a disabled individual.
But since the source material really digs into the mechanics of the 5-year rule for historical context and for certain beneficiaries like trusts, we should probably explore it.
We should, knowing that the 10-year rule is its modern successor. The alternative choice to the stretch back then was the 5-year rule. It was essentially a more rapid liquidation, either by choice or by default if you missed the stretch election.
And there's a quick historical side note here. The RMD requirements were actually suspended for the year 2009 because of the financial crisis.
That's right. So if you were counting the 5-year period for an account inherited in 2008, 2009 was disregarded. The 5-year window was effectively 6 calendar years long. It just shows how sensitive these deadlines are to legislative changes.
Okay, let's do a deep dive into that 5-year rule. Whether it's the old 5-year or the new 10-year rule, the underlying principle is forced, rapid liquidation. Why was the stretch payout so vastly superior?
Well, we have to understand the 5-year rule because it often applies when a plan defaults to it, or when a beneficiary just fails to make a timely election for the life expectancy method.
Yeah, so what are the mechanics?
Under the 5-year rule, the core requirement is that the entire account balance has to be withdrawn over the 5-year period following the year of the decedent's death.
Does that mean I have to take 20% out every year?
This is the key difference. The 5-year rule offers internal flexibility within the period. It does not require a specific or even amount each year. You could actually take nothing in the first 4 years.
But that flexibility ends violently in the 5th year.
Exactly. The critical point is that the entire remaining balance becomes a required distribution on December 31st of the 5th year. So if you have $1 million account and you haven't touched it for 4 years, you must take $1 million taxable distribution in year 5.
And that massive distribution could instantly push the beneficiary into the highest income tax bracket, trigger IRMAA, and essentially wipe out a huge portion of the inheritance in taxes.
It's a huge tax planning dilemma. You have control over the timing, but the tax cost of that forced large withdrawal is almost always prohibitive.
So when did this 5-year rule apply?
It applied in a couple of key scenarios, mainly around a pre-RMD death.
Mm-hmm.
First, if the decedent died before their RMD start date and the beneficiary did not elect the stretch lifetime payout by the deadline, which was usually December 31st of the year after the death. If they missed that election, the 5-year rule became the default.
And the second scenario involves situations where there isn't a person with a life to stretch over.
This is a massive planning trap. It applies if the decedent died before their RMD start date and had no named person beneficiary. For example, if the estate or charity was named as the beneficiary.
Right. An estate or a charity doesn't have a life expectancy.
So they're forced into the 5-year rule, or the 10-year rule today. This is why beneficiary designations are the highest form of tax planning. Listing the estate is a common administrative failure that forfeits decades of tax deferral for the heirs.
Okay, this is the most crucial distinction. What happens if the decedent died after having started their RMDs? The flexibility disappears entirely, doesn't it?
It does. The 5-year rule does not apply if the decedent died after having started their RMDs. So if they died later than that April 1st deadline, the 5-year liquidation option is just off the table.
So if the owner was 75 and had taken 3 RMDs and then passed away, the beneficiary must immediately follow a specific life expectancy payout schedule. They can't wait 4 years.
That's the difference between flexibility and mandatory annual withdrawals. In that post-RMD death case, the beneficiary takes distributions over the life expectancy determined by one of 2 methods.
What's method 1?
Method 1. If the beneficiary is a designated person, like a child, they use their own life expectancy from the single life expectancy table. They must take an RMD every single year based on that table.
And method 2?
Method 2 is if a non-person entity, like an estate, is the beneficiary. In that case, they must use the remaining life expectancy that the decedent would have had based on the age of the decedent in the year of death. This is often the least generous schedule, leading to the fastest required liquidation.
So the small chronological difference, the owner dying at 71 versus 73, completely determines whether the beneficiary gets 5 years of flexible timing or a mandatory annual withdrawal.
The takeaway is clear. The moment R&Ds start, the planning landscape changes drastically. Before R&Ds start, you have more choices. After R&Ds start, you are locked into annual mandatory withdrawals based on one of the life expectancy tables.
Let's revisit that unfortunate scenario where someone names their estate or a charity as a beneficiary. If they died before RMD started, we established this forces the 5-year or 10-year rule.
And this is the most common and costly planning error, the forfeit of the stretch. If the decedent named their estate or a charity as a beneficiary, No stretch payout over a person's life is possible, no matter how young the ultimate heirs might be.
What if the estate or charity is only a partial beneficiary? Say 5% goes to a charity and 95% goes to their son.
That small non-person share can contaminate the entire account. The same complication holds true for the entire account unless specific remedial measures are taken.
What kind of measures?
If a non-person is a partial beneficiary, the entire account is often subjected to the less favorable payout rules unless that non-person share is distributed, cashed out, or officially disclaimed by September 30th of the year following the death.
So that September 30th deadline is critical. It gives the heirs about 9 months to untangle a messy beneficiary designation and ensure the individual beneficiary can still qualify for the most favorable payout.
The technical lesson here is profound. If you want your heirs to have the maximum possible tax deferral, you must ensure only individual designated beneficiaries are listed, or specific types of properly drafted trusts. Anything else risks sacrificing decades of future tax-free growth.
That was an intensive journey through the world of mandatory withdrawals. But let's synthesize the most critical nuggets for you, because avoiding that 50% penalty and maximizing deferral are our dual goals here.
Start with age. You have to be certain of your personal RMD starting line. Is it 70.5, 72, or 73? It's all based on your birth year. And remember that delaying your first RMD until April 1st of the next year might feel convenient, but it risks that costly income bunching.
Next, remember the calculation. Your RMD is based on your prior year-end balance divided by the factor from the Uniform Lifetime Table. And never, ever forget the 50% penalty. It's an excise tax on the under-withdrawn amount plus the ordinary income tax you still owe.
Operationally, distinguish between your accounts. IRAs are flexible. You can add up your total RMD and take it from one account. That's aggregation. But employer plans, like 401ks, are rigid. You have to take a calculated RMD from each individual plan and use the qualified charitable distribution, the QCD, to satisfy your RMD while reducing your AGI.
And finally, beneficiary distributions. It all hinges on that single timeline question. Did the decedent die before or after they started RMDs? Pre-RMD death opens the door for more flexibility, like the 10-year rule. Post-RMD death limits options to a rigid life expectancy schedule demanding annual mandatory withdrawals.
The R&D framework, in essence, is a mandatory bridge between tax deferral and mandated distribution. It's complex because it's the meeting point of investment strategy, tax law, and estate planning.
So what does this all mean for your long-term planning, whether you're 40 or 70?
Here's where it gets really interesting and, I think, provocative. Since the payout rules for beneficiaries change so drastically based on whether you die before or after starting your RMDs, and whether a person or a non-person is named, the level of detail and proactive planning required is intense.
It's not just a retirement issue.
Not at all. You may be years away from your first RMD, but your beneficiary designation today is effectively predetermining the tax status of that inheritance for the next 40 years. By failing to check a box or update an old form that lists your estate, you could be setting the stage for a forced, painful tax liquidation for your children, eliminating the value of the tax deferral you worked so hard to build. That's why financial planning is truly estate planning.
A compelling reason to review those beneficiary forms immediately. Thanks for joining us for this deep dive. We'll see you next time.